Morning, market chameleons and soon to appear. My favorite chameleon, Dimitri Pargamonic. How you doing, Dima?
Good morning, Will. How are you?
So we're going to try another day of question and answers, correct?
Yeah, I think so. We'll continue doing it maybe for the rest of the week, as long as there are questions out there, and hopefully we're getting to a lot of them. But maybe we'll continue for the rest of the week, see if we have questions that other people might, when somebody asks a question, somebody else might have the same type of question, or it could lead to something more. So we'll just do the rest of the week, potentially just customer Q&A.
Great. Now, for those who don't know, I did put the link to the Zoom meeting in the YouTube chat. If you click over to that, you can actually ask your question live with your own voice. You don't have to show your face, but it is always helpful and leads to a more interesting question or series of questions if you ask it live, I think, and we can really dig into the details. I don't know what you think, Dee, but I think it is helpful.
Yeah, definitely, because sometimes you can put the questions in a chat. Sometimes when you type in a question, when we read it, we might be interpreting the question differently than you're asking. So if options are a little bit complicated, trading's a little bit complicated. So when you're putting a question in a sentence, sometimes it could be simple, no problem. But if you think you have a question that's better asked, live, we're putting a link on there. You don't have to put on your video camera, but we'll hear you. And then you could ask the question, and this allows us to kind of also be able to interact and have a conversation, so we know we're getting the question correct, right? Because a lot of times we read them and we're not sure what the question is.
Perfect.
Yeah. So
actually, you can pop over. You don't even have to give your name if you don't want. That's
if you don't want to. Yeah, it's just a way for for the question. Just it could be more clear that way. Anyway, so what I'll do is I'll start kind of looking at the pre-market report, seeing while the questions are queuing up. Or if anybody wants to come over, and I have some things that I've wrote down based on like email questions that we're getting. So I'll start going over those until we get some questions coming in.
All right. And before we get started with the pre-market and the questions, let's get to the disclaimer. Why don't we do that?
Yep. So keep in mind, everyone, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
Excellent. All right. What's going on in the pre-market?
Thanks, Will. So let me share my screen real quick. And here we'll start out just taking a look at, these are stocks trading in pre-market hours. We've got the most active stocks, biggest percentage gainers, biggest percentage decliners. I see 131 stocks made our percentage gainers list, 29 on the percentage decliners list. So from that perspective, looks like we're setting up for a more bullish bias at the open. I'm going to take a look at the higher market cap stocks to see if there's a different picture there, or we're seeing the same thing. So these are market cap 20 billion market cap or higher. So we see 32 made the percentage gainers list, 7 on the percentage decliners list. So not very big list, but it does look like right now we're setting up for a more bullish bias at the open. We are coming out with earnings, so let's take a look at that unless we're getting questions coming in. But I'm going to use this filter here, has earnings. So this is looking at pre-market stocks that are trading in pre-market hours that announced earnings either yesterday after the close or this morning before the market opened, and now they're reacting to the earnings. So I see 15 right now made our percentage gainers list, 5 on the percentage decliners list. There's about 50 of them so far that reported earnings. Some of them are kind of a mix, not very big moves. We see Apple down a little bit, 0.8%. Then you've got like Microsoft up 1.5%, so not very big movers here that I'm seeing on these lists. I just see GE up 0.5%. So while we're waiting, what I could do is just take a look at how so far stocks that have been reporting earnings, if they've gapped up in the morning, if they gapped down, how did they do the rest of the day? So I'm going to come down here, and this is here a list. If you scroll down, we get another list of stocks, and these are stocks that in the last 20 trading days, we have the gap up stocks in the morning and the gap down stocks. So these are stocks that were gapped down in the pre-market, and then the stocks that gapped up in the pre-market. And we have statistics here on how they did the rest of the day. So we could see, if we start out with the gap up list, that those stocks that gapped up, how did they do from the opening price? So we know from yesterday's close to the opening price, they gapped up. What did they do the rest of the day? So we see here by 10 a.m., 44% of those went higher, 56% lower, but on average gained 0.1%. So it looks like the ones with the up moves exceeded the ones with the down moves. By the end of the day, 43% of them drifted higher from the open, 56% lower, for an average loss of 0.9%. So now we got that control group. Let's compare that to those stocks that reported earnings and gapped higher. So I'm going to use this filter, has earnings. So here we see kind of a similar picture. Those that had earnings went hot, gapped up higher. 41% of them continued higher from the opening price, 59% lower from 9:30 by 10 a.m. By the close of the day, again, 41% went higher, 59% went lower, for an average loss of 1.2%. So I'm going to filter this down further and say, well, what about the S&P 500 stocks? So here, S&P 500 stocks. Here, we also see that those S&P 500 stocks reported earnings, gapped higher. 37% of them went higher by 10 a.m., 63% lower. So the majority of them were not able to hold on to those gains at the morning. And it looks like, in the morning, a lot of them reflected the most optimism, kind of backed off. By the close of the day, only 33% of those drifted higher from the opening price, 67% lower. But here on average, they gained 0.2%, which is telling me that some of them, here's the data below, that some of them by the end of the day may have added a lot to the gain. So we see here DPC, ZMG, gapped up in the morning. By 10 a.m., it was higher. This is the opening price, 10 a.m. price, closing price. So you could see kind of drifted higher the rest of the day. But again, the majority of them were not able to hold on to that early gain from, at the open. What about the ones that gap down? So let's take a look at those. So this is, I'm using the same filters, S&P 500, stocks, reported earnings in the morning, trading lower in the pre-market hours. What happened to them? So here we see that 45% of those continued higher by 10 a.m., 55% lower. But by the end of the day, 65% of those that opened lower from the opening price to the closing price drifted higher. So looked like that was an opportunity to potentially buy on weakness, right? So most of that sell-off created an opportunity to buy. 65% were higher, 35% continued lower, but on average gained 0.8%. So the data here shows that whatever that morning move was tended to be an overshoot. It overshot either to the upside or overshot to the downside. And, to the upside, that was an opportunity to sell and take profits. To the downside, it looks like that tended to be an opportunity to scoop up stocks because they overshot to the downside. So far,
we have a couple people who are new and or just joined. They just wonder how you got to this screen again, the pre-market screen. How do you get to the report?
Right. So under stocks, pre-market trading, that's up here, you click on it, and you start out on the top, it's showing you the summary data for today, right? So those are the top part is showing today's pre-market movers. If you keep scrolling down the page, then you get a table, and this gives you kind of an analysis of the last 20 days, right? So these are stocks in the last 20 days. We saved the data, so then you could kind of take a historical peek, what tended to happen to these pre-market movers the rest of the day, right? So what did they do after the open? And that's kind of the question that you're trying to answer below. And you got a bunch of filters to narrow down, just like I did over here, to see if you're looking for a specific group, what tended to happen to that group. Of course, I could release this. I could release S&P 500. Maybe you want to look at biotech stocks. What happened to biotech stocks that gapped up? You could do it that way. So you could see here, biotech stocks that gapped up. I'm sorry, I'm going to gap down. Let's go back to gap up. Biotech stocks gapped up in the last 20 days. Looks like that opening, again, tended to overshoot because only 35% of those that gapped up continued higher to the close. Were able to hold on to those gains and add to the gains. 64% looks like they were not able to hold on to those early gains and sold off from that opening price, losing 2.5%. So these are just a historical peek into the most recent history, what tended to happen to these pre-market movers after the open. And any questions, Will?
No, that's very helpful, D. Actually, okay. I just see a question we have. I just popped over to Zoom. This is based on the pre-market stats. It's coming from Michael. He's like, based on the stats you just shared, gap up percents, it looks like there's a greater chance, 50% probability that the gap will be filled. Am I reading this correctly?
So when you look at that, let me try to, I think, and again, it's always better to ask these questions live because then we don't have to interpret the.
Michael's in Zoom. Maybe he'll come on live. Mike, type in if you'll come on live or raise your hand and I'll let you come in. It's just your voice. You don't have to, you just have to have a mic on your computer.
And if he's not doing it, I'll try to answer the question.
Yeah, Mike says he'll come on live. So let me click over. I'll bring him in.
Okay. Awesome.
All right, here we go.
Hey, Michael, I think it's on mute. Your mic is on mute.
Hey guys, can you hear me?
Hey, Mike. Yep.
Wow, this is amazing. First of all, let me say that I'm a new subscriber, and I'm absolutely blown away by the quality of this data. I mean, this is big data on steroids, and
thank you.
I'm an engineer by background, and I just love data, and my ability to find the edge and having a place where I can go and find that edge, because without that edge, we just, we in Vegas, right? Is extraordinary. So thank you very much for this incredible service. So so
thank you.
My question is, so looking at the percentages, right? You want gap up, gap down. It looks to me like, if there's a gap up pre-market, then there's less than 50%, like 44%, 43%, that the gap up actually will, the move to higher is going to continue for a small change, and actually a greater percentage, like 56 on the screen I'm looking at, that the move is going to be down. In other words, there's going to be a gap fill. So it was both gap up, gap down seem to have the same kind of split. So am I reading this correctly, that this potentially could be a gap fill play for us?
Yeah. So exactly? So this is what it's shown is when we gap up, right? What percentage of the time does it hold on and add to those gains, like you were saying, or what percentage of the times it doesn't even hold on to that gain, and that morning price, that opening price, we will sell off from there. So you're right, and this is two different. We separated. If you go between the tabs, one just has the gap up stocks, one has the gap down stocks. And sometimes when people say it fills the gap, that implies that whatever percentage move it makes, let's say if it yesterday closed at $100 and it opens at 110, it's up 10%. And some people, when they say fills the gap, it goes back down to 100. So this does not necessarily mean like it fills the gap. It's just saying that if it closed at 100 and it opened at 110, by the end of the day, if it's down, that means it was below 110, okay? Or what percentage were above 110, okay? So it doesn't necessarily mean 56% went all the way back to the previous close. It just means that new opening price, what percentage of them were higher from that new opening price and what percentage were lower. Does that make sense?
Yeah, perfect sense. And actually, a gap fill doesn't necessarily mean that, to your point, the close is going to be below the close of the day from the previous session. What could happen is in the morning, in the first 30 minutes, right? The price, this could be a high volatility price movement where the price going to come down, fill the gap, and then turn around and keep going the other way, right? So
exactly, yeah, it could be, right. That's why we kind of divided it into two time frames. One is just that first half hour where we see a lot of volatility, and where besides that opening price, right? Because the opening price will reflect that opening rotation where all the orders are queued up in the morning. The specialist opens it up, but then right after 9:30, you're going to see another flood of orders coming in. That's what we usually historically we see a lot of volume in that first half hour in the last hour of the day. So that's what we kind of,
if you permit me, and again, I'm so grateful for you allowing me to speak. It's incredibly powerful what you're doing here.
Thank you.
A third line in this table that I'm looking at right now, I'm wondering whether you can pull from your data, right? You can pull the percentage of gap up at the open that actually fill the gap, let's say before 10 a.m. Because I one of my trades is a gap trade, right? And this is huge for me, right?
Right.
Hey, Dean. Brad is typing into the YouTube chat that maybe you want to show Mike the gap up and go feature.
So so there are other reports that you could take a look at, besides this one. This one looks at a historical view, but there are some like gap up and go, and these are stocks up here which actually gap up on the day and then continue to rise. The other ones are gap down and go. So these would be like the ones that actually gapped up in the morning and then continued, this is the opening gap, and then it continued to rise. But I think Michael's question was different. What percentage of them actually closed the gap by 10 a.m., right? So if they went from 100 to 110, how many of those actually went back down to 100 by 10 a.m.? Is that correct, Michael?
Yeah, that would be a very interesting sort of, by stock. There would be a very interesting stat, because some stocks will have a tendency to close the gap more than others. I mean, we all know that there's a lot of research around, when you have a price chart, you have gaps in there. Those are basically those will attract the price to actually come back and try to close the gap at some point. So we could use that as resistance or support. And the statistics around percentages for a particular stock, the percentage where a gap is going to be closed at the open, let's say within the first 30 minutes, because you already had it by 10 a.m. Would speak a lot towards my ability to find an edge in a gap trade, for example, in the morning in a particular stock.
Right. Well, I'm gonna make, I don't have that statistic in front, not on this report, but I'll make a note of it and see if that's something, we could make a future enhancement on. But at this point, I don't have it on this report. I just, that's what we have here is just from the opening price, what they did. So they didn't necessarily have to fill the entire gap. It could have gone, if it closed at 100, went to 110. If it went down to 105, didn't go all the way back to 105, we just consider that was down from the opening price. So that's how we measure on this report. But I'll take a note of it and see if that's a statistic we can create.
Thank you.
Yep. Thank you, Mike.
Michael, thanks for coming on. That was a big deal. Now, Michael, I think this may be his first day on. I haven't seen him in the chat, so that's great that he came on. So much.
First, I just started my subscription, and I'm a huge fan, and I look forward to learn from you guys because my goal for 2021 to become a consistent trader. Separate conversation. I'm not there yet.
No, thank you. We've really appreciated because not a lot of people. I think people have questions. I know that because I get emails, but sometimes, and even in the emails, it's hard to interpret the questions. So coming on and saying it live, it's a big help, and it takes, I know people are nervous sometimes to do that. You have to be a little bit brave, but it helps out us and it helps out people in the community to hear that.
Yeah, no, the chat on YouTube is very positive about this discussion, and we're very thankful that Michael stepped up and came on. And Michael, if you don't know, there's a Discord group. A lot of traders just like yourself. It's not run by Dimitri or I. It's actually one of the most active chameleons. Jake set it up. If you want access to that Discord group, just email me, williammcbride@gmail.com. A lot of the things you're talking about are constantly discussed amongst chameleons, how they use the tools. So it's a nice resource. I'll put that in the chat so you can email me and anyone can email me if they want access to that Discord group.
Thank you.
Great.
All right. Thank you,
Mike. Bye.
Yep. So are there any other questions that are queued up right now, Will?
Nope.
Okay. So another question that I got, I wrote down a bunch of them. So I'll just kind of go in some of them that I feel like repeat, some questions that I heard repeat. So one of the questions is about credit put spreads, and it's to screen a credit put spread by an IB% rank. Okay, so let's just go to a credit put spread screener real quick. And I think this comes from potentially either, people reading about, a screen or seeing it on YouTube. So I kind of wanted to describe what's going on here on the credit put spreads. And when you're when you're screening something by an IB% rank. So an IB% rank, right? What you're doing is you're trying to screen for something that has a high implied volatility or low implied volatility, right? That's why you're ranking implied volatility. And the idea is if you're looking for a high IV, you're looking for potentially selling that implied volatility in anticipation that it's too high. You want to sell it and profit from it coming back in, right? So the implied volatility went way beyond its mean, and you think that the realized volatility will be below what the actual implied volatility is suggesting. Option prices are too high. And that means you want to sell Vega, all right? When you're doing a spread, a vertical spread, it's not a Vega play. You're actually, not really looking at that. That's not the strategy. If you're screening for a high implied volatility to sell or low implied volatility to buy, that's not the right strategy of vertical spread, because you're buying and selling an option, right? So when you're selling an option, you're selling Vega. When you're buying an option, you're buying Vega. So you're buying and selling an option in the same expiration. Okay. So you're doing it in the same expiration. You're buying and selling, and these are offsetting. And when you're doing it, right, when you're doing it, depending on the strikes you're doing, you could be long vega or short vega with a vertical spread. Okay, so when you're and I know where people are heading with it about implied volatility. That's why we create theoretical values, taking into consideration what happened to the stock during periods of high implied volatility and periods of low. That's already embedded in there. But if you're just screening by implied volatility, it's not really this is not the strategy you would be using. So let me give you an example here. But I take this first one over here. And whenever the stock moves, right, the closer the stock moves to your long strike. So you see here, I'm looking at the stock here, and if I'm selling an option, I'm selling this 162.5 put, and I'm buying the 157.5 put. That's a credit put spread, right? Selling the higher strike put, buying the lower strike put. When the stock moves, the closer the stock moves to your long strike, you're going to be long vega. The closer it moves to your short strike, you're going to be short vega. So in this situation, the one I'm showing you right here, right, this stock is closer to your longer strike. Let me show you what that looks like on August 20th. So I'm going to click on here, because remember, your vega will be the highest at the money, right? So the closer the stock moves to your strike, your vega will be the highest. So let me show you here. This is the spread, August 157.5 put, and you're buying and you're selling the August 162.5 put, right? This is what it looks like, at expiration. But look at your vega. You're actually long vega, right? So people equate, well, if I'm getting a credit, I'm short vega. That's not the case, right? That's not the case with vertical spreads, because you're in this situation, the strike that you're long is closer to the stock price than the strike you're short. The one you're short is further from the stock price, making you long vega. Okay, so I think what people are equating is that, well, if I'm just selling a spread and I'm collecting money, if I'm getting credit, I'm short volatility. That's not the case. And you have to pay attention to your risks that are involved. So if you're just screening for implied volatility, assuming I'm doing a credit put spread and I'm selling implied vol, I think that's what people are assuming. That's not correct. And you could start with a short vega position, right? I could even start you off with a short vega position. Depending where that stock moves, you could be long vega, okay? Because here you're actually not putting on a strategy based on implied volatility. A vertical spread, unhedged, you're not hedging your delta, you're not hedging. It's really a delta play, okay? It's more of a delta play than a vega play, because it depends where the stock's going to move. Okay, that's your whole position is going to change. Unless you're hedging your delta along the way, then you're trying to scout realized volatility versus implied. But if all you're doing is selling that put spread, you probably this is why we create these theoretical values to help you out, and we'll show you how we do it. And this will look at the historical stock behavior of the stock to say, well, what do we think this put spread will be worth based on historical stock behavior. And it's also taking into account where the implied volatility is today and looking for similar situations in history. So it's kind of embedded in that theoretical value already. So you don't have to screen by IV rank, but screening by IV rank here does not make that much sense when you're looking for a vertical spread. Is that helpful to people?
Yeah,
Hopefully
that is helpful.
that answers the question. Because remember, if you're playing implied volatility, what is your vega, right? Because the only way, if you think vol's going down, you have to be a short vega. because if you're long Vega, you're gonna lose on the way down. So that was one question that kind of pops up. And if there's follow-up questions, no problem. Like, let me know. You could come on, ask the question, type it in.
Well, we did have a question about, now I know it's 9:30, maybe we can get to it tomorrow. Rob was asking about Apple's earnings and how it responded, and maybe we can look at Apple in the rearview mirror tomorrow. That was a question. And we had another question from a new user about the analysis maybe from an options chain. I'll copy that down so we have it for tomorrow. Great job, Dima. Thanks so much, buddy.
Thank you. And then actually, you know what? Maybe we'll start out with the options chain because we did do some enhancements to it really quickly. Let me see if I could show it. I mean, I guess we could get to it tomorrow.
We'll do it tomorrow.
Let's get to it tomorrow.
I don't think I could show a question. I'll send it over to you. Again, we'll put the link out. Anyone can come on live tomorrow. Great job, Dima. Thanks as always, brother.
All right. Thanks, everyone. Thanks for joining. Thanks for the questions. Mike, thanks for coming on, asking the question live. Stay safe out there, everyone. Have a good trading day and hope to see you guys tomorrow.
Trade in peace, Chameleon. See you.